Hey folks, welcome back to the channel. It's Liquid here. Today I want to talk about what happens to the stock market when the Federal Reserve starts to cut interest rates, which will happen this week on Wednesday the 18th. We'll get a decision at 2 p.m. Eastern. So some people might think the stock market will fall when the Federal Reserve starts to cut because it means the economy is about to get worse, which is bad for corporate profits, while other people think interest rate cuts are good for the stock market, and this marks the beginning of a rotation from bonds into stocks. Because as you lower rates, the price of existing fixed income assets go up, which means they get more expensive, and equities become more attractive than newly issued bonds because those bonds have lower coupons. So which one is it? Today, we'll take a look at what happened to the markets when interest rates were cut during the last 3 times that this happened, and hopefully get a better sense of what to expect in the S&P 500 going forward. For a while, economists were expecting a 0.25% cut. However, that's changed, and as of today, the 15th, there is a 59% chance the Fed will drop rates by 0.5%, compared to a 41% chance of a quarter point drop. So it just goes to show how dramatically these things can change. But the point is, we're going to get a cut, whether it's 25 or 50 basis points. It doesn't matter too much because the important thing is that the rate cutting cycle is about to begin. And the reason I say cycle is because there is likely going to be a continuation of further cuts after this one. Because back in 2000, interest rates plateaued for 233 days before the Federal Reserve cut, and they did not stop for a long time. During the Great Financial Crisis, it was 447 days. But again, once they cut, they did not stop. In 2019, it plateaued again and just stayed flat for 225 days before the first cut. Now, currently, we are here at 417 days. So historically speaking, we are due for a cut. Now, notice what happened every time in the past where interest rates were cut. Not long after, the economy fell into a recession, which are indicated by these gray columns. So it is very likely to happen again this time, where we see a rate cut followed by an economic downturn. During the dot-com bubble, the Fed held an emergency meeting on January 3rd of 2001, and that was a 50 basis point cut, which was the first of many more to come. And here's what the SPY looked like on January 3rd, which is this gray vertical line over here. It was during this green candle that the rate cut was made. So first thing to notice is the market traded in a very wide range that day, which is to be expected. Every time there is a Fed interest rate change, you would expect some volatility. But compare like all the candles before it and all the candles after in like a 1 month range. This is the biggest candle. Another thing to note is the market generally went up over the next couple of weeks. We can almost draw like a channel like this showing the bullish direction of the market, and that lasted for about 3 weeks. After that, look what happened. You had this massive 21% drop in the span of like 1.5 months, went back up, met resistance, and then continued another leg down. So for the people saying the market should go up, well, yeah, that's what happened in 2001. It went up a few weeks. But for the people who say that's the beginning of the market crash, well, they're also not wrong, because after the initial pump, we got a massive dump. So let's move on to the next one and see if there are any similarities between the two. The financial crisis prompted the Fed to cut in September of 2007. And again, that was a 50 basis point drop to start the rate cutting cycle. So that was September the 18th, which is over here. Similar to last time, very big range comparing to the weeks before and the weeks after on the daily chart. It's one of the biggest candles. Actually, the day after it was the biggest candle, this doji right here. Very volatile day because it went basically down, tested the bottom of the previous day, and then bounced right back up to finish the day at pretty much where it started. So we're already seeing some similarities between what happened in 2001 and 2007 at the start of both rate cutting cycles. Pretty volatile day followed by an uptrend in the weeks after that. Maybe something like this. And after the rate cut, the market basically went up for 14 bars. So again, about 3 weeks, and then it never closed the day higher than that point again, and pretty much went down after that. And if we look at what happened in the months to come, well, similarly to what happened last time, but not as dramatic. It did go lower, but then bounced made a lower high, continued going down, made a lower low, went up, met resistance at pretty much where the previous support was, bounced off of that. So very likely it's going to head lower from here, which it did. So once again, first, a couple of weeks of up days, even surpassing the previous resistance here, which at the time was like all-time highs for the S&P 500. Normally, when you break out on the top and you reach new all-time highs, the market should continue to go that way. But in this case, it was a false breakout, trapping a lot of bulls because they thought the market was going to go higher. So they held onto their long positions, thinking maybe they would get out once the price gets back to that level. Unfortunately for them, it did not go back up there for many years later. So that was a look at 2007. Finally, this one right here during the pandemic. And what's noticeable about this one that's different from the previous two is this rate cutting cycle started with 25 basis points instead of 50. Does that make a difference? Let's take a look at the SPY daily chart on July 31st of 2019. And what's similar is that we still get a very volatile day, and then the following day also expected to be a wide range candle as well. But then instead of going up like how the other two started, this one actually went down right away. I mean, the market before the rate cut was actually above the blue 21 EMA, which represented an upward trend. But then after the rate announcement, it quickly changed directions and went below first the green 9 EMA and then the 21 EMA. So instead of going up for a couple weeks, it went down the first week and lost about 6%. And then from there, it just went into this chopping range for the next couple of weeks, which sort of forms this wedge, meaning it's continually making lower highs and higher lows until eventually it broke out of that on the upside and went higher. Now, one thing to always be mindful of is the previous resistance level, which was back here, because that was pretty much the previous high. And if the market cannot go past that and it meets resistance there, then there's a chance that it's going to go the other way, which it did here. There were no days where it closed above the previous high back in July. And, even if it does close above there, but it's not sustained, then that's what happened last time. It was a bull trap. It was a false breakout. So it continued going down, but it did find resistance down here many months later and then went up until it finally broke through that resistance, backtested with these couple of candles off of the green EMA, which means, yep, pretty much this is going to continue going up, at least for now, because the green line, blue line, red line are all pointing upwards, and the price is above all the lines, representing the uptrend should continue. And that's pretty much what happened until February of next year, 2020, and that's when the market just tanked. But really, it's hard to correlate this massive drop with the Fed's interest rate cut just because it's been so long since that decision was made. This was 203 days. So that's more than half a year. And, if we're going to make trading decisions 200 days into the future, it's not going to be as accurate as making shorter term decisions just because there are way too many factors that would come into play as time goes on. So that takes us to today. What we've just seen in the past, that it's possible for the market to chop and maybe go up for the first couple of weeks, especially if the first cut is 0.5% instead of 0.25, because in both cases where the first cut was half a percentage point, you had this pattern where the market went up for 3 weeks. But then what happened in the months afterwards is you get this rather large correction. And that's happened 2 out of the last 3 most recent times when rate cuts began. Or the 1 out of 3 times we know what could happen is the market goes down after a rate cut. And then it goes up, breaks the previous resistance, and goes much higher, which is what happened in 2019. Now, personally, I really doubt that's going to happen this time, like a repeat of what happened over here. Because if you look at the angle that this bullish market is in, that channel is much steeper than the previous bull channel, the larger one that the market was going in, which meant this angle was unsustainable. And it was likely going to come back and either retest the top of this channel, go into it, or break right through it. So the reason why I say it's not likely to go above this time, even though it happened last time, is because of the long-term trend. If we look at the S&P 500 over a 100-year period, and I'll just change the range to 12 months, and I'm looking at the S&P 500 index itself because the SPY did not exist 100 years ago, of course. So each of these candles represents 1 year. And of course, when we're dealing with long-term data, it's more accurate to use a log scale. So I'm going to go down here in Trading View, click the little settings button and change this from regular to logarithmic. And we can pretty much draw a line that connects 4 points of the stock market on the top here. You can see that's 1, 2, 3, and 4. And for the bottom, we can also draw another line that maybe looks something like this, which forms an upward wedge. And for the next decade, it's likely the market will continue to go inside this wedge. And right now we are at the top of this century-long wedge. I would not expect the market to go much higher than that, because then it would break an upward resistance line that's been respected since the 1920s. So that's literally like 100 years ago. So we have like a little bit higher that we could go to, maybe 5,700. Right? Because we're at 56.26 right now, which is why I'm saying the market, like the first two examples I was showing, the market could go up a little bit higher for the first few weeks, but I wouldn't be surprised if we get some kind of correction after that. So, all that said, what can you do about the Fed cutting rates now that you know this information? A couple of things to think about. First is you can consider doing some volatility plays during Wednesday, which is when the Fed announces the rate cut, and Thursday. So, for example, if I go back to the SPY over here, Wednesday, the 18th would be here. So this is when the Fed will make their rate cutting decision. If you believe that, like what happened in the past, you're going to get some volatile days, especially, during the first few days after the rate cut, then at the end of the day on Tuesday, you could put in a reverse iron condor option strategy, which expires the next day, or even Thursday or Friday, which will be profitable if you have big moves in the market. And then don't forget to take profit once it goes to like a 50% gain, because the thing with volatility is the market can move up just as easily as it can move down. So you don't want to lose all your paper gains. So that's one strategy you could implement. Another thing to consider is to watch for the upcoming weeks after the rate cutting decision, because what tends to happen in the months after that depends on those first few weeks. Because when the market goes down during the first few weeks, it tends to go up over the next few months. And similarly, if it goes up during the first few weeks, like in 2001 and 2007, then it goes down over the next few months. That seems to be the pattern of what happened in the past. So one thing you could potentially do, if it turns out that the market does one of these two things, which is to go up a few weeks or to go down a few weeks, then maybe you could wait for the turn and make a medium-term decision with your trades, maybe buying some option spreads either at the money or out of the money with 1 to 2 month expiration, anticipating for that big move, whichever direction you think it may be going. So that's it for now. And, again, not a guarantee, but if we get a 0.25% cut, this blue line will likely be the scenario. But if we get a 50 basis point cut, then this green trajectory will likely be the scenario based on previous rate cutting cycles. So thanks a lot for watching. Hope you got something useful out of this video. Good luck with your investments, and I'll talk to you in the next one.